You see here, this is roughly what, October-ish or June-ish 1995. That's a monthly chart. I'm not sure if you can see the complete left side of my screen, but around June-ish or so, 95, the pair hits 38 to 22, which, by the way, as we speak, is a strong level to watch in the next 24 hours, actually like 12 to 24 hours. The euro currently is at 37.80, and please don't go and enter any trades based on what I say today, especially if you're, I should say this again, beginner or intermediate. Feel free to use the demo accounts, but and I'll cover this in the end. So 38.22 is a nice level to look at today in the next 24, 48 hours. That was the high there. It's gone down to, I think its all-time low is 82.30. So that's the high, that's the low. So if I draw a fib like that, that's my 100% retracement. See that? So it comes back just shy of 100%, whatever that is, 98% or so. It falls back short, and it breaks that 100% line or that 1.00 and starts going back up. But look at what had happened. It went till 1.32. My 1.382 is 59.58. It went till 60.37. Now, again, if you're new to this concept, like I was a couple of years back, I had trouble understanding why did it break 59.58. It went till 60.37, right? Well, this is a monthly chart, right? And as amazing as it is, at times it will come to the pip on support resistance and Fibonacci's and go your way to the pip. But there are times when the market disobeys. As I said, these are speed breakers on the road. Somewhere between a speed breaker and a complete thick wall, and the speed at which your car is traveling, essentially the fundamentals that are driving the car, it may either whiz through, glide over the speed breaker, crash through the wall, and your windshield won't even break because of the speed at which the car is going, i.e. the fundamentals or the buying or the selling from the macro funds. Let me tell you something else here. Nobody can predict the future. Nobody. I can't. I'm pretty sure Jeff can. We have a reasonable understanding of what's going to happen. Do you seriously think that when the Greek Prime Minister, I can't pronounce his name properly, Paparandou, the referendum that he went through, I mean, that even caught Merkel and Sarkozy off guard, right? They were even surprised with his move. Now, at least that's what they say in the statement, and I wouldn't be surprised if they were surprised. So if folks at that level don't know, and that news has caused the Euro USD to fall short. That being said, if you were following the fundamentals, and even though the EU ministers came up with the 1 trillion for the EFSF, which is in some vague form still there, whether it's a special purpose vehicle or 20% guarantees or whatnot, but nonetheless, they came up with the 1 trillion euro number. They took the 50% haircut on the Greek bonds, and they came up with 100 or 110 or 20 billion dollars for recapitalizing the banks. Great news, there was great euphoria and the Euro USD spike, but because of lack of details, most of the economists out there, and you could have gauged this yourself, didn't expect this rally to last. So that was there nonetheless. Even if the Greek guy did not come up with the referendum, I think the chances were strong that rally would not have sustained. None. So that's how you become astute as a trader, and especially if it starts hitting a strong number like 42.81 or 42.80, whatnot. Anyways, what the Greek guy did was he just made the fall a little bit early, right, and deeper for anything else. So okay, back on my charts, the subject. So that's how you draw an extension. Retrace. Yes, extension. But when you talk about retracement, so if you look at the right-hand side of the chart, the stop here, 60.37 down to the low here, you pretty much draw a fib, and coming back up, it did a 76.4%, and that's what you have as a retracement. Once again, as I go through more slides, you get a little bit better. But the point I want to make here is both Fibonacci retracements and extensions are equally important, and are good price points to keep in mind to get into a trade, or to take some profits if you're already in the trade. both ways. Once again on the chart, and again I just kind of borrowed these slides from the training material that we already have on the site. So when you refer to as an intra-year reversal, intra-year period, it's 52 weeks. A year comprises of 52 weeks, right? So in this particular snapshot, this is a daily chart, and this is an entire year. I'm trying to again show a couple of points here. From this low to high, you have a little fib, 61.8%. That's how you do a fib. In a retracement, this blue stick from this top to this low, an extension was 1.61618 around here, so on and so forth. It's kind of interesting or important to look at an intra-year trend reversal, or intra-year is the pair still bullish or bearish. I'll just read through this. The 50% mark of 52-week high-low is considered the intra-year trend reversal line. If the price stays above this low to this high, that's 50%. If the price stays above the 50% line, the intra-year trend is considered to be bullish. If the price stays below the 50% line, intra-year trend is considered to be bearish. Again, something to keep in mind. This may not necessarily help you get into a nice trade, may not, because it's good to know if the pair is generally bullish or bearish, but what really helps you is understanding where the pair is at the current point in time in context to the overall monthly, weekly, daily charts. That's the technical side. And on the fundamental side, do the current news events. The big picture I mentioned about earlier, overall, and the current news events support the current bullish or bearish trend or the current retracement that's just happened. So, you have to kind of keep it playing in your mind. Okay, here's another chart that shows a little bit more of Fibonacci's. So there's a proper Fibonacci level. So that again, 38.22 down to 82.30. Now we'll notice, and it's something that makes sense for me. So depending how you want to do it, I think almost every platform gives you this opportunity to color your charts, whatnot. Bearish ones are show red, bullish ones are show green, the more current ones are show blue, so on and so forth. All kinds of things, and I do tend to confuse myself at times, but it works for me. You should do what works for you. Just some ideas to look at. Where there are overlapping fibs like this 38.38 and 38.22 is pretty close. That's by the way a support resistance level. When there are overlapping fibs and support resistance, that is a golden opportunity you should look at, along with the ATR that I'll discuss shortly if I move along faster. Once again, combination of conventional support resistance and non-conventional Fibonacci's, which we also refer to as support resistance. When they line up, the more they line up, the stronger the tick was. Imagine again the small speed breaker I mentioned on the highway. If a couple of support resistance levels from the big picture and the fibs start lining up, you start creating a thick wall. And when you start creating a thick wall, it'll find it difficult to break through that level. Okay.